Do you catch yourself worrying about whether the stock market is going to go into another bear market like it did in the early 2000s decade? Not like these nice little short and sweet bear markets we've had in the 2010s decade. Or do you underinvest because you're worried about the market? Do you just find yourself sort of caught up in your emotions around investing? Well, if so, you're definitely going to want to see this video. Hi, I'm Camille Gaines here and on my website, retirecertain.com. I write about and I share about what I've learned from investing for about 40 years now, as well as creating alternative income streams for the past 15 plus years, along with my husband. One of the things that I've found with investing over the years is how big of a role our emotions play with investing. Now, this isn't just me. This is proven, right? It's documented. All these studies have shown. And not only that, but these specific emotions have been pegged to specific points in the market cycle. So I want to show you a chart I made that is an investor emotion chart that has at the various points in the cycle the emotions that we feel. Now, I didn't invent this originally. I couldn't find the very first person that did this. A lot of people have these. But what I did is I added in what I've observed in my own investing over the years, as well as in my work with financial coaching clients, about what happens at various stages in the market cycles. And I put them on my own chart, which you're seeing here. You can see this at retirecertain.com on my website if you'd like to check it out, or you can even put it on your own website if you're into finances like I am, or you're a financial advisor or someone that would like to share this. All right, so let me delve in and make sure you stay to the very end, because I'm going to share with you what I've found to be the best way to address investor emotions, my emotions as an investor, help my clients around this so that we invest to get the best returns we can, not based on emotional decisions. So make sure you stay tuned to the end. So let me dig in. First, I want to tell you three sort of tips or steps that you can take to help you overcome your emotional investing and sort of tame your emotions, I guess I should say, when it comes to investing. And then we'll look at all these different points on the cycle, and we'll talk about where we are and what happens at these various points with things that I've sort of identified as these places on the market cycle. Because when we're in these places, we can't identify them. I mean, we all know at certain times the market is overvalued or we're near the highs. This is going to be less about where we are right now, because I want this to be a value for someone that's looking at it in a year or 2 years. And it may be that in a year or 2 years, we're in a completely different place than where we are now. So I want anyone to be able to look at this video and say, yeah, this is where we are right now, and this is how I'm feeling, and this makes sense to me. That's what we're going to do. And I have this information again on my website in an article called Investor Emotions Chart. And you can take a look at it and ask yourself these very questions if you want to see this in written format. But these are the sort of questions you can ask yourself to help you identify where we are in the market cycle. Has the stock market been rising or falling in recent years? And sometimes we can look, for years and the same thing has been happening, like many years, or we can look a little bit shorter term, like 1 or 2 years. So that's a good thing to ask, is has it been going up or down in recent years? The next question is it most probable the market is in the middle of an upward or a downward trajectory? And sometimes that's really obvious, and sometimes it's not, because sometimes the market consolidates or goes sideways before it makes other sort of a direction change up or down. The next question is it most probable the market is near the top of a long-term cycle? The next question is it most probable the market is near the bottom of a long-term cycle? And these sound sort of ridiculous, but with investing, all we have is probability. We don't know for sure. We can never know for sure. And when we look back over, hindsight's 2020, as they say, we can see these things. So we always just have to say, is it most probable? Is it most probable my investment, my retirement savings will last the rest of my life? We don't know that for sure, right? There's no way we can know. Is it most probable I'll get this return? Is it most probable we're near the top of a market cycle or closer to the bottom of a market cycle? So that's all we're really trying to do here. And what are investor emotions now? Are investors excited, fearful, depressed, thrilled? What's going on with other investors? Is there a lot of hype, or does everyone hate stocks? So those are the questions. Now let's take a look at the chart here. And we start out with optimism, okay? We're hopeful that the stock market is going to go up, or else we wouldn't invest in stocks. And this is sort of where the cycle begins, and you'll see it's also where the cycles end. All right, so engagement with other investors at this point fuels optimism. Sometimes we can't see our own emotions. I know I can't. And so I can look and see other people's emotions, and that can help with this. And it can help us identify our own emotions as we look at other people. So how are other people acting about stocks? Is there a lot of hype? You can look at forums like Reddit and see what's going on. And then investor greed or other factors drive the market higher here as additional funds are poured into the market. And then that optimism turns to excitement, and more money is poured into the market. This helps fuel these emotions. So we get excited. After we're optimistic, we see we've made a little money in stocks. Maybe we went ahead and sold some and actually locked in some capital gains. Or maybe we just watched our portfolio values go up. Either way, we're feeling pretty good, and our optimism has moved on to excitement. Investor greed and other factors are driving the market even higher in here as we see our account values going up. All right, then we hit thrill. I've brought out the champagne bottle here. Once investments increase significantly in price, emotions intensify from excitement to thrill. Investors begin to feel even more confident in their investing. Eagerly, at this point, a lot of investors really start tracking their investments even more because, well, it's exciting when we look and see that our investments have gone up in value. I've felt all of these emotions, and I'm just a regular person. I have to keep them in check. And I think everybody does. So then up here at the top, though, ooh, it gets euphoric. Right up in here, people start planning their financial futures around what has happened this may be 5 years. Usually it's a few years, but we start planning based on what we've seen lately. It's something called recency bias, and it leads us to think that this is going to happen forever. So we start making plans to retire early, retire in our 50s, or even earlier, retire in our 40s. We're like, wow, this is fantastic. I'm making 10% a year. I'm planning on making this indefinitely, and I know with this I'll be able to retire at this time. Boy, this is great. I'll just keep investing in stocks. All right, so it feels like it's going to go on forever. What happens up here also sometimes that's kind of scary is a lot of investors they scale back on their defensive assets like bonds or like extra money market, and they invest more in stocks because they see they can get a higher return if they're in the stock market, because they've missed out if they haven't had their money in stocks. And this happens a lot at this stage. Here's the thing. It feels like risk is low up here. Everybody's making money with stocks. It's worked so well, and we feel confident, and we feel like risk is low, okay? But in actuality, risk is higher because we're loaded up on overpriced stocks that are valued really, really high relative to historical values. and another term for this, let me throw it really quickly, is over rational exuberance. And that's sort of a term that's commonly used with the stock market up here at the euphoric phase. So what happens though is the market, maybe it breaks down just a little bit up here at the top, and it might go sideways. I was saying it consolidates at those levels before it decides to go up some more or down, and it starts feeling a little anxious when it doesn't come back up over those new highs. And that's how the market works. I'll do another video on how that happens and how the market hits up against those previous highs and before it can break back up over it. But that's what happens up here. And we start getting a little anxious when we see it's not doing what it's been doing the last few years that was so successful. People become anxious, investors become a little more anxious. People do tend to hold on here. A lot of investors buy on the dip because that's what we've been encouraged to do. Buy on the dip and buy more. But then let's say the market drops a little bit more, and when we move from 20% or more, we go into a bear market. Up to that 20% mark, that's called a correction. And that's super normal. It's going to happen. They're all normal. Bear markets are normal. Corrections are normal. This is all normal, and it's a reality of stock market investing. I want to make sure I say that. So this is all normal. It just feels bad. Then we start getting into denial down here though, because maybe the stocks have gone down more. Investors start talking about sticking with the plan that they've been encouraged to stick with. They start thinking and saying, well, I'm a long-term investor, so I'm just going to ride this out. And we may even have more buying on the dips, which causes the market to sort of go up and down, and it gets really tricky to know where we are in the cycle, because this is a really long cycle, and along the way we have these little gyrations up and down. All right, so then the next stage is fear. We start getting a little worried, that we're not going to be able to maintain our plans that we had. We start getting fearful that perhaps these investments are not going to return 10% a year as we had hoped for. We become more aware of the drawdowns, it's called, from our high point up here where the euphoria was down to where we are now around fear before we come into desperation. At this point, maybe investors delay home purchases. They start saying, well, let's see how the market plays out. Our assets, our stocks have dropped by, maybe 20%. Let's wait and see how this plays out before we commit to buying a new house. And this leads to this decline here, and this fear starts leading to more selling of stocks. And then what happens is investors start feeling kind of desperate because they see that their plans that they made up here aren't working out. They don't know what they're going to do about it. And a lot of investors who work with financial advisors call their financial advisors and beg them to sell their stocks, and insist that mutual funds be liquidated if investors are DIY investors, and that drives selling even more, because when the institutions come in and start selling, there's this huge volume, billions of dollars, that further put pressure on the market and make it fall even more. And there's panic down here as investors feel really upset and worried about stocks. Emotions are really heavy down here. The talk among family and friends has gone from the best stock pick as it was up here to, I'm concerned, I don't know what's going to happen, I've had devastating losses. A lot of people don't admit that. Corporate profits start being hurt because consumers aren't spending money like they were when they felt great up here. And this all just makes all of this worse down here. And the panic is followed by something that's called capitulation. Now, What happens down here, it looks so logical, but keep in mind, investors, they can't feel these things. They're not really recognizing this, particularly over here, and how their emotions are being so tied to these cycles, which are out of their control. Now, capitulation, it's the point of maximum pain when the stock market has gone down and investors, they feel like they can't take it anymore. A lot more investors throw in the towel, they give up, they can't take the pain of the declines in their portfolio anymore. There's a selling frenzy. Investors may sell because they realize they simply can't have any more risk. They can't lose more of the value of their portfolio. Down here, the next thing that happens is investors become despondent. They never want to own stocks again. Stocks are selling at low prices. Here's the thing. It feels really risky down here, but risk is lower because stock prices are so low. Up here, risk was high because our money was tied up in these overpriced assets. And down here, well, we've got kind of, for the most part, the same companies. Maybe earnings have slowed down. They probably have. If not, they will. They probably have already, though. And it's basically the same company, though. So if it's a good company and their financials are stable, then there's less risk down here, even though it feels so much riskier because we've experienced all this on the way down. People start losing their jobs because companies start laying off because they're losing money. And at this point, investors feel like stocks will never go up again. Then the effects of the bear market hit the economy even harder. It's intensified by all these investor emotions. And the next thing that hits is depression. Here I am sort of hiding depression a little bit, but there it is right there. Investors understandably feel extreme emotional pain because their plans for the future have been wiped out. The wealth that they made from the bull market has deteriorated. It's gone. And the market usually doesn't fall below where it was on that last low point, but that's a whole other video. Down here, investors are depressed and they feel very awful about investments, and they swear many investors swear they'll never buy stocks again. But then you know what happens? Investors start getting hope again because stocks start edging up again. Maybe the economy has just started getting better, or maybe it's about to start getting better and all the signs are there that this is about to happen. So investors start buying back into the market again. Institutions come in, the market responds, and investors start having hope. Investors next feel relief because they see, oh boy, the investors that stayed in the market say my investments are finally, thank goodness, starting to come back up again. Investors that bought low, that were really clever down here, are really hopeful and feel relief because they're seeing that they've made money off of those lows. And then investors start feeling optimistic again as the market starts rising up even more, and they recognize that we've been through this cycle of emotions around and all along this cycle that the stock market has gone through. Now, I want to point out a couple things. These cycles can happen with other investments. It can happen with gold, or it could happen with real estate. Most of us have seen this happen with real estate, as we've seen the value of our homes, or rental investors like myself have experienced this in the cycle. And what I want to share with you now is the thing that I've seen to really, really help with avoiding investor emotions, and that is to realize that you can choose how much risk you have. A lot of investors don't feel like they can choose this. They feel like, well, I've got to have money in stocks, 70% in stocks and 30% in bonds, or whatever it is, 60, 80%. A lot of investors now, even investors that work with financial advisors, have a lot more in stocks because bonds interest rates are so low. So investors feel like a victim to their investments. I get that. I totally get it. These things are out of our control. But the way that we can avoid these emotions, in addition to just looking to see where we are in the cycle and seeing what others are experiencing and what we may be experiencing, the other thing we can do is realize that we have a choice about how much risk we want to take on and invest based on our choice about risk. And we can do that by estimating about how much risk we have at any given time. I call this my stock drop factor. I have another video on this that you'll want to check out if you're concerned about losses in the stock market. That's what I wanted to share with you in this video. Remember, retire certain.